IFRS number 10 usually guides us on how a company acquires shares in another company. Suppose company A buy 80% of the ordinary shares of company B. Company A will be referred to as a parent company and company B will be referred to as a subsidiary company. But we want to understand that anytime we talk about company A acquiring 80% of the shares here, in our consolidation, we are referring to 80% of equity interest. Of course, when you talk about equity interest, we are referring to the equity interest of the subsidiary. Therefore, if I look at the parent company acquiring 80% of equity interest, of course, if I take the accounting equation of the subsidiary here, where we normally say that our asset is equals to equity plus liability, then this is the portion that we are referring to as the asset. Here we are. All these are our asset here. And this is now the composition of our asset there. And of course, when we refer to as the equity and liability, we are referring to these sections of our statement of financial position, and this is what we have in this particular portion there. Then if this particular equation can be rearranged, we have now equity will be equals to asset minus liability. Of course, now if you look at this asset minus liability, it is the same as the net identifiable asset. In our consolidation, the net identifiable asset, which are also represented by equity, this equity is composed of what? Share capital, share premium, retained earning, and fair value adjustment. Therefore, this particular portion where we have said that company A has acquired equity interest of company B, we are referring to this component here, and this component we are able to see them within our statement of financial position. Sometimes when you look at the acquisition, the parent company has to pay to acquire those net identifiable assets, and this is what you usually refer to as the purchase consideration, what the parent pays to acquire the subsidiary. This may take of different forms. It can either be a cash payment, which is immediate cash, share exchange, a deferred cash, which is the payment made later, a contingent payment, which depends on the performance, or the loan stock, which are the debentures or the debts issued. When you look at the equity interest, the parent company only acquired what we refer to as the 80% here. So it means that there is a portion which was not acquired by the parent, and that particular portion belongs to a group of shareholders that we normally refer to as the non-controlling interest. Non-controlling interest is the portion of the subsidiary which have not been acquired by the parent. Therefore, these are going to be minority interest, and if you look at our case here, where we have our parent acquiring 80%, then it means that there is a portion of 20% from the subsidiary which have not been acquired by the parent, and this is what belongs to the minority interest or minority shareholders, who are usually referred to as the non-controlling interest.